resilient and serve as a source of strength to the economy in both good times and bad, when the financial system comes under stress. In our market economy, like any businesses, banks compete with each other and pursue profits by balancing risk-taking with safety and soundness. But because of the key role banks play in the economy and the fact that banks do not fully internalize the costs of their own failure, regulation and supervision must ensure that banks do not take on excessive risks that can cause widespread harm to households and businesses. Bank failures are as old as banking, and we've seen repeated waves of bank failures over the centuries. America learned that lesson the hard way nearly 100 years ago, when bank failures played a central role in the Great Depression. In response, the United States and many countries around the globe set up a system of deposit insurance and enabled emergency lending in times of stress. To balance the moral hazard of the federal safety net, Congress established a framework of regulation and supervision to make it more likely that banks internalize the cost to society of their risk-taking. But finance is always evolving, and the buildup of new risks led to the banking crisis of the 1980s, and then to the global financial crisis, with devastating consequences. Weaknesses that were revealed in regulation and supervision led to unprecedented and unpopular bailouts and shuttered American businesses, devastated local communities with foreclosures, and millions of individuals lost their jobs and their livelihoods. Government responded in the Dodd-Frank Act in 2010 and in regulatory reforms by significantly strengthening bank oversight to curb excessive risk-taking. The message from the American people was clear. Risk-taking must be balanced with the overarching need to maintain a resilient banking system that can continue to play its central role for households and businesses in good times and in bad. Another perennial lesson from the history of bank regulation and supervision is that the job is never done, and that the constant evolution of finance means risks will also evolve. As Vice Chair for Supervision, I have recognized the need to approach this mission with humility, aware that I don't have all the answers or perfect foresight of where things can go wrong. Both regulators and banks are limited in our ability to comprehensively identify and measure risks. Our financial system is complex, interconnected, and evolving. We cannot fully appreciate how a specific vulnerability can interact with other vulnerabilities to amplify and propagate risk in the face of shocks, let alone accurately anticipate shocks in time to avoid them. When I became Vice Chair for Supervision in July 2022, the global financial crisis was almost 15 years past, and much had been done to strengthen the resilience of the system to reflect lessons learned. But in March 2023, we experienced the second largest bank failure in history, Silicon Valley Bank, and the subsequent failures of Signature Bank and First Republic Bank. SVB's failure triggered stress throughout the banking system and required the issuance of a systemic risk exemption and the creation of an emergency bank lending program. We have made some progress towards addressing the gaps that led to these failures, but there will be headwinds that we must guard against in the coming years, as well as ongoing vulnerabilities in areas of risk that require continued vigilance. Earlier this year, I announced that I would step down as Vice Chair for Supervision, but remain a member of the Board of Governors. It has been an honor and a privilege to serve as Vice Chair for Supervision and to work with colleagues to help maintain the stability and strength of the U.S. financial system so that it can meet the needs of households and businesses. I've determined that I would be more effective in serving the American people from my role as governor. In this role, I'll continue to participate in monetary policy deliberations and vote on matters before the board, including those related to supervision and regulation. While it was a tough decision to make, I believe it was the right decision for the institution, and more importantly, for the public whom we serve. The risk of a dispute over my position would be a distraction from our important mission. I feel strongly, as Chair Powell has said publicly many times, that the independence of the Federal Reserve is critical to our ability to meet our statutory mandates and serve the American public. Put simply, our mission is too important to let such a dispute distract from doing our job for the American people. Since my term for Vice Chair for Supervision will end later this month, I'd like to use one of my last opportunities as Vice Chair to discuss 7 specific risks ahead. I mentioned the speech would be long. 7 specific risks. First, maintaining and finishing post-crisis reforms. Second, maintaining the credibility of the stress test. Third, maintaining credible, consistent supervision. Fourth, encouraging responsible innovation. Fifth, addressing cyber and third-party risk. 6, risks in the non-bank sector. And 7, climate risk. Each will continue to be a risk in either the near or long term. Let me start with the task of maintaining and finishing post-financial crisis reforms. There is always pushback on financial regulation. I felt that even in the wake of the global financial crisis 15 years ago, as I helped to draft the legislative response to that crisis, the Dodd-Frank Act. And I felt that over the last few years, as he worked to finish the job of post-crisis financial reform and take up evolving threats revealed from the latest banking stress. It's important to get the balance right, but it is also important to stand up for the American people. I urge regulators to finish the job of implementing the final plank of the global financial crisis reforms, and not to dismantle the hard-fought resilience that banks have built up in the process. Of course, there are always ways to increase efficiency and reform prior methods without cost to resiliency, and I support those efforts. But as I've spoken about many times, capital is critical to absorb losses and enable banks to continue operations through times of stress. And capital requirements should be aligned with the risks that banks take. The Basel III endgame reforms include many improvements to how we measure credit, trading, operational, and derivatives risks in light of our experience in the global financial crisis. All major jurisdictions except the United States have finalized rules that would implement these standards for their internationally active banks. The Federal Reserve played a central role in developing these standards in the many years before my arrival as Vice Chair. The board sought comment on a proposal in July 2023 to implement the Basel III reforms, and we received a wide range of comments on the proposal. On the basis of those comments, I took steps last fall to outline broad and material changes that would better balance the benefits and costs of capital in light of comments received, and would result in a capital framework that appropriately reflects the risks of banks. These reforms had broad consensus on the board and the support of the heads of the Office of Comptroller of the Currency and the Federal Deposit Insurance Corporation. When the US provides leadership in international forums like Basel and then follows through, we set a powerful example and establish a standard that other jurisdictions also uphold. Implementing international standards enables US firms to compete on a level playing field across the globe and makes the system safer. When we don't follow through on our commitments, for whatever reason, concerns about a level playing field rise in other jurisdictions in an international race to the bottom on standards. This harms us all and makes US banks less competitive. And unless the US implements these standards, other jurisdictions will force US banks operating abroad to meet their standards instead. Let me turn to unfinished business from the March 2023 banking stress. In that event, we learned that bank runs and bank failures can happen fast, much faster than before. Before SVB, the largest bank to fail did so over a period of several weeks or even months. The deposit losses experienced by SVB were much greater in both relative and absolute terms, and they occurred in less than 24 hours. Over the past 2 years, the Federal Reserve has worked with banks to improve their ability to borrow from the discount window, and the financial system's collective readiness has improved significantly compared to pre-SVB, including with a substantial increase of $1 trillion in collateral pledged across the system. The Federal Reserve has also worked to improve the functioning of the discount window through a concerted effort to gather public input and identify areas for modernization. These efforts have improved the ability of banks to weather stress, both individually and collectively, which enhances financial stability. However, there's still much more work to do. For instance, banks, even the largest banks, are not currently required to establish a minimum level of readiness at the window. And as a result, there are outlier firms that are not prepared for stress. This needs to change. Without a requirement, there is also a significant risk of backsliding on the substantial progress and readiness we have made since March 2023. Another important lesson from SVB is a classic one. Balance sheet vulnerabilities among a group of institutions can be a source of contagion for the financial system and thus a key financial stability risk. While we did much to improve the resilience of globally systemically important banks, or GSIBs, in the past decade, March 2023 showed that significant systemic risk can develop and spread from stress anywhere in the system, including in large and regional banks that are not GSIBs. The resilience of these firms has improved as they have recognized their vulnerabilities, and we have worked through supervisory channels to encourage risk management practices that put them on a firmer footing. But we also need to put in place more durable solutions to address risks. For one, the level of capital held by large banks need to align with the underlying risks on their balance sheet. One important step would be to finalize the requirement that all large banks reflect unrealized losses on available for sale securities in their capital, which is a reform with broad agreement. This will help them manage interest rate risk before it gets to extreme levels, a significant problem revealed in the banking stress of 2 years ago. Another lesson from the spring of 2023 is that large and regional banks, as well as GSIBs, should ensure that they can actually monetize the securities on which they rely for their liquidity. Why does this matter? Banks need to be able to turn a portion of their assets into cash with a speed sufficient to meet outflows when uninsured depositors or other short-term creditors demand it. Regulation needs to reflect realistic assumptions about monetization. We should also consider updating some assumptions about deposit outflows in our liquidity requirements so that they better align with observed stress behavior. During the stress in 2023, we saw uninsured deposits from high net worth individuals and certain entities, such as venture capital funds, behave more like highly sophisticated financial counterparties than non-financial companies or ordinary retail depositors, which is how they are generally treated in regulation. This mismeasurement of risk in deposit outflows means banks may not have sufficient liquidity to manage a stress period. In a related vein, banks have stepped up their use of reciprocal deposit arrangements where deposits are spread across many banks within a network, as a way to manage the risk of deposit amounts over $250,000. While this arrangement spreads risk across the banking system, it is a strategy that has not been tested in a large-scale stress event. It is only logical to wonder how the attenuation of relationships between customers and banks under reciprocal arrangements will affect the behavior of depositors worried about a bank run. We also need to be attentive to operational risks in these arrangements, as well as the risk management capacity of these companies to manage these relationships under stress. The final lesson from the bank stress 2 years ago is that we need to do more to ensure that all banks that come under stress can be resolved in an orderly fashion. One way to do this would be to require all large banks, including those that are not GSIBs, to issue certain amounts of long-term debt. This would have helped reassure depositors worried about the stability of bank funding and aided in the eventual resolution of at least some of the banks that came under stress in 2023. The banking agencies have proposed a rule on long-term debt requirements. We have received many helpful comments that led us to adjust it in draft form, and I support moving forward to finalize it with these adjustments. As I mentioned, Basel III standards, revised long-term debt requirements, and to be proposed liquidity standards would help to address gaps in our current framework, and I continue to believe they should move forward. Moreover, banks and supervisors should also stay vigilant to known risks in the current environment. For instance, risks remain in the commercial real estate market, particularly within the office segment, as borrowers may find it difficult to refinance maturing loans. And interest rate risk, especially for those with high levels of uninsured deposits, remains a key area of focus. Let me turn to the second area of concern, and that's stress testing. We face a challenging environment with the Federal Reserve's annual stress test. The stress test helped the financial sector emerge from the global financial crisis and rebuild its credibility. The annual stress tests are still important to the financial sector's credibility today. The stress test helped bank, market participants, and supervisors understand the bank's vulnerabilities to shocks and to guard against those shocks by holding sufficient capital. In December, the board announced that due to the evolving legal landscape, we would be undertaking significant changes to the stress test to reduce capital volatility and improve transparency. While I recognize that we need to increase transparency to reflect changes in the legal environment in which we operate, there are good reasons why I and many of my colleagues and predecessors have been averse to such full disclosures since the inception of the stress test 15 years ago. There are several risks that we will need to guard against. First, we need to guard against the risk that the process results in reduced capital requirements. As they did during the Basel III process, banks are likely to argue against various aspects of the Fed's models that result in higher capital requirements, and not to highlight the areas in which the models underestimate risks. We should take these comments on the Fed's models seriously and adjust the models as appropriate. But we should be careful not to overcorrect and lower bank capital requirements in ways that underestimate aggregate risk. The Administrative Procedure Act should be a vehicle for transparency and public input into agency action, not used to weaken regulatory requirements that preserve the safety and stability of our financial system. Second, we need to guard against the risk that banks lower their capital requirements because of increased transparency. Increased disclosure of details about the Fed's stress test models could enable banks to optimize stress test results by adjusting their balance sheet based on their knowledge of where the model underprices risk in order to reduce their capital requirements without materially reducing their risk. Gaming the test in this way would be a bad outcome for risk management and our economy. Third, banks are likely to change their behavior in other ways that increase risk. We should be aware of the risk that full transparency into the models and scenarios used by regulators could discourage banks from investing in their own risk management if the tests became too predictable. Full transparency may also encourage concentration across the system in assets that receive comparably lighter treatment in the test. And banks are likely to reduce their management buffers over required levels, which will bring greater risk of breaching the minimums and regulatory buffers when a significant risk event eventually occurs. The fourth risk, and perhaps the greatest one, is that over time, given the difficulty of navigating the notice and comment rulemaking process on an ongoing basis, to update the models that we use, the dynamism and accuracy of the stress test may fade. And as the events of 2 years ago show, it is hard to predict where risks will emerge in the financial system. An inherent challenge of preserving the relevancy of stress testing is coming up with a set of adverse scenarios that are novel enough and dynamic enough to reflect the risks that banks may face from unanticipated developments. I believe that the Fed should commit to investing in a credible, effective process to maintain the dynamism of the binding stress test by regularly updating its models and scenario variables to reflect changes in the environment and changes to bank behavior. This will require resources and a strong commitment up front and over time, but it will be necessary to maintain a credible stress test. One effort we've already undertaken should help to maintain the dynamism of the stress test. We launched exploratory stress scenarios to consider a wider range of possible outcomes. The Fed used this approach during the pandemic, and we've now made it a regular part of our annual stress test exercise. The exploratory scenarios are not used to set binding capital requirements and are only reported on an aggregated basis. But they help the Fed better understand risks posed to individual banks and to the banking system as a whole that are not captured in the binding exercise. I hope and trust that the Fed will continue this important analytical work. As an additional backstop to help ensure banks have sufficient capital to withstand losses, the Fed should preserve its discretion to set individually binding capital requirements on firms based on supervisory judgment under the International Lending Supervision Act. Jurisdictions around the world undertake a similar process under what's called a Basel II approach, a Basel Pillar 2 approach, and the United States would benefit from using such a framework as well. That is all the more important given the changes the Fed is undertaking for the binding stress tests. Let me turn to the next area, and that's maintaining credible, consistent supervision. There will undoubtedly be calls to revamp supervision to reduce burden, and I'm all for making supervision the most effective and efficient it can be. Supervisors need to focus on the most urgent and important risks and not burden firms with unnecessary or distracting matters. But we need to be careful to preserve and enhance the ability of supervisors to act with speed, force, and agility as appropriate to the risk. Supervisors emphasize proactive supervisory engagement, which helps banks to address issues before they grow so large as to threaten the bank or broader financial stability. Earlier intervention means that firms are likely to have more options to fix their problems with little impact on bank profitability. We should continue work to improve the effectiveness of our supervision and use data-driven analysis to improve our scoping and prioritization of supervisory issues. I support this work to the extent that it makes our supervision more effective and focused on the right issues. But the board should resist initiatives that impede effective supervision by discouraging examiners to flag issues early, or initiatives that increase unnecessary process around issuing findings in a manner that impedes the speed, force, and agility of supervision when it is needed. More generally, supervision is another area in which efficiency and competitiveness should not be used as an excuse for lax oversight that significantly impairs the safety and soundness of individual institutions and undermines broader financial stability. We should take caution from our experience with SVB 2 years ago. While some have claimed that the examiners at SVB did not focus on the right issues, it's important to highlight that the Office of the Inspector General concluded that the Fed allocated an insufficient number of examiner resources to SVB while it was in the regional bank organization portfolio, and that the examiners assigned to SVB as it was growing did not have sufficient expertise in supervising large, complex institutions. Once it was in the Fed's large bank portfolio, examiners highlighted the risks from interest rate risk and uninsured deposits, but did not act with sufficient force to get the bank to change its course in a timely way. We've made important changes since then, but we need to be sure we get the staff resources in place and provide support to examiners on the front line so that they can act with the speed, force, and agility warranted by the facts. Let me turn to the area of innovation and technology in the financial sector. Innovation, when done responsibly, brings tremendous benefits to consumers, financial institutions, and the economy at large. For instance, blockchain technology underlying crypto assets has the potential to make financial services better, cheaper, and faster. Responsible use of this technology could make banking more efficient and accessible to more consumers. With any new technology, there are also new risks. To achieve the benefits in a durable manner over time, we must ensure that the associated risks are managed appropriately. With crypto assets, investors do not currently have the structural protections they've relied on for many decades in other financial markets. It's important that these guardrails are put in place to avoid issues such as the misuse of client funds, misrepresentation, obfuscation about the availability of deposit insurance, and fraud. We should also recognize that some of the attractive attributes of crypto assets, the pseudonymous actors that are parties to transactions, the ease and speed of transfer, the general irrevocability of transactions, also make crypto assets attractive for use in money laundering and terrorist financing. It's encouraging to see innovators develop tools and processes to better manage these risks while harnessing the benefits of the technology. But regulation and supervision also have an essential role to play. Responsible innovation is in everyone's interest. In the past few years, we stood up the Novel Activity Supervision Program which dedicates resources to understanding how technology is transforming banking and supports banks' ability to innovate while ensuring that banks clearly understand and manage the risks associated with innovative activities. I hope and trust that approach will continue. Let me turn to cyber risk and third-party risk. Cyber risk from both foreign powers and non-state actors has become a major concern for banks, and regulators will need to ensure that these risks are being properly managed. The operational disruption propagated through a third-party security company last summer was a wake-up call for banks and regulators about vulnerabilities in a system where security is outsourced. Disruption of one of these critical systems may compromise a bank's ability to execute important functions and adversely affect individual firm safety and soundness, as well as the broader financial system. Given the significant concentration in the IT industry, we should expect operational failures at a single IT entity to have potentially far-reaching effects, no matter their original cause. And advances in artificial intelligence are likely to give bad actors new tools for fraud and infiltration, while also providing banks with new tools to combat these attacks. Both banks and the Federal Reserve need to continue to invest in cyber resiliency. Let me speak next to the perennial concentrations and concerns in intermediation by financial firms outside the bank regulatory perimeter. An increasing, varied, and evolving collection of non-bank clients, including hedge funds, private credit, and insurance companies, is playing a significant role in the global economy and presenting new risks. Beginning with hedge funds, bank exposures to hedge funds have risen over the past several years, and concurrently, hedge fund leverage remains near historic highs. Archegos' failure revealed the risk presented by hedge funds and the degree of interconnections between banks and hedge funds. And the exploratory analysis as part of last year's stress test showed that banks have material exposures to hedge funds under certain market conditions, and that the hedge fund counterparty exposures can vary significantly based on the specific set of shocks. One area that has grown substantially is the Treasury cash futures basis trade. The basis trade helps provide liquidity and price discovery in normal times, as hedge funds trade with asset managers and other financial institutions to align returns in holding Treasury securities and related Treasury futures. But the trade involves high levels of leverage, what can contribute to a rapid unwinding in positions and exacerbate market stress, as we saw in the spring of 2020. In principle, margining practices and participants' risk management activities should limit these risks, but individual firms do not account for the spillovers their action can have on market functioning. These externalities suggest a role for regulation, and the central clearing mandate for Treasury market trading is an important step in supporting the resilience of this market. At the same time, we need to continue to consider how we can support the collection of minimum margin across trading venues and in bilateral trades to avoid loopholes and risks, and continue to monitor banks' credit risk management practices with these hedge fund counterparties. Another area that has experienced rapid growth in recent years is private credit, which is now comparable in size to the high-yield bond market and leveraged loan market. Traditional private credit arrangements rely on limited leverage and generally have long-term funding, making them less vulnerable to the deleveraging spiral associated with high leverage and short-term funding. Nonetheless, risks may be growing. The connections between private credit and banks have been expanding, and private credit remains opaque, with limited information relative to asset classes of similar sizes. Moreover, the rapid growth and opacity of the sector raises the risk that recent private credit arrangements may be taking on new risks. Retail investors, for example, can now gain exposure to the asset class through mutual or exchange-traded funds, which could present the age-old consumer and financial stability risks we see when opaque illiquid assets are converted to liquid ones. We also need to continue to monitor risks in the insurance sector. Households planning for retirement often rely on life insurance companies to provide them with a steady stream of income. In principle, life insurance companies are the ultimate patient investor, and thus the natural vehicle to finance long maturity and risky projects. Indeed, while venture capital funding gets a lot of the attention, mobilized retirement savings through life insurance companies have supported long-term investments in capital-intensive projects. However, life insurance companies, just like other financial institutions, can overpromise and be tempted to take on greater risk than their liability holders or regulators appreciate. Given the complexity of some of these investment vehicles, the institutions themselves may not fully appreciate all of the risks. The life insurance sector has been changing. Even as the life insurance industry has been increasing its holding of assets originated by private equity firms have also been acquiring life insurance companies directly. Moreover, private equity affiliated insurers rely more heavily on non-traditional liabilities, which may prove flighty in a stress event. This is something to watch carefully. In the next business cycle downturn, it's possible that unexpected losses in insurance companies could lead to a sharp pullback and deeper credit crunch. Finally, regulators will need to continue to confront the financial risks from climate change. The Federal Reserve has a responsibility to recognize emerging risks to the safety and soundness of banks, to the ability of households and businesses to access financial services, and to financial stability. Costly natural disasters could present just such risks. The recent wildfires in California should be a wake-up call that we need to focus on how insurance markets will need to adjust to more frequent and severe weather events. The loss of life and hardship borne by many households is tragic, and the economic losses associated with the wildfires, while uncertain, are likely to be among the largest losses from a natural disaster on record. The wildfires should remind us of the problems in property and casualty insurance markets, just as the severe flooding caused by Hurricane Helene reminded us of significant gaps in flood insurance coverage. Often, the structure and regulation of insurance markets prevents risk from being appropriately priced, limiting the ability of market signals to influence the development and adaptation in high-risk areas and contributing to the buildup of risks. And there is a broader question of the extent to which private capital will be sufficient to cover increasing natural disaster risk. The Federal Reserve has an important but narrow role to play with respect to climate change, and that is to focus on risks from climate change to bank safety and soundness and financial stability. The pilot climate scenario analysis conducted by the Federal Reserve was an important step forward in assessing the capacity of the largest banks, as well as in building our own capacity to perform the kind of analysis that is increasingly crucial as risks arising from more severe weather events become a driver of financial risk for specific firms and the broader economy. Guidance for the largest banks also plays an important role in reminding banks of basic principles in prudent risk management as it applies to these types of climate-related risks. In conclusion, the United States has the benefit of a strong, vigorous economy, the deepest and most liquid markets in the world, and a critical place in the world economy through the role of the US dollar. The Federal Reserve has an essential role in maintaining the strength and resilience of the US economy, including through its vigilance about the risks I discussed today. A strong and resilient banking system benefits the American people. We need to be humble about our ability to predict shocks to the financial system and how they will propagate through vulnerabilities in the system. That is why it is so important to have strong regulation and supervision as shock absorbers to protect households and businesses from risks emanating from the financial system. In closing, I want to speak directly to the staff of the Federal Reserve, those here in the room and those who are watching online, and express my deep gratitude. Your rigorous analysis and deep expertise are fundamental to our ability to promote a strong and stable financial system that serves the American people. Thank you for your outstanding service. And thank you to all of you for listening to me today. Now you get to the fun part.
The fun part, that's right, that's right. If there are any questions as well, more questions, can I just you both up? Oh, or in that as well. So sorry.
Is that good?
That is perfect.
Okay. Thank you.
So amongst other favors that you've done, I see some of my former students, so who have gone through financial reg and capital requirements, including Basel 1 and 2 and 3. So now you've validated that time that they spent
Well
going through
used.
liquidity. That's right. That's right. All those ratios, kids. It can be pretty helpful. Okay, maybe we'll just ask a couple of questions, and also if there are questions either from the students or from the reporters, feel free. Maybe Zainab or Matt can maybe help to identify who may have some questions. But first, that was a long list of both. It was really both a little bit of a retrospective, but it's also looking forward. Just sort of maybe taking cue from that retrospective of the fact that you've had a very busy term as vice chair. If you're going to look back, like what exactly are you most proud of? What do you see as something that 5-10 years from now you'll be thinking about and really still smiling about?
Thanks, Chris. Well, let me just say some of the things I'm proudest of are things that hopefully nobody ever hears about.
Yeah.
In the sense that, for example, when SVB failed in the spring of 2023, one of the things I'm proudest about is how we came together as a team to manage that crisis at the Federal Reserve, across the U.S. government, and with the private sector. And that could have been a situation that would have gotten significantly out of control, but it didn't. That stress in the banking system was contained, and we were able to prevent broader spillovers to the U.S. economy that could have affected the ability of households and businesses to borrow and to conduct their activities. We've also done a lot of work internally to improve the way supervision is done, the speed, force, and agility of supervision. And when supervision is done right, you never hear about it because banks don't get themselves into trouble, or if they do, they find a way out of that trouble more expeditiously. And we've done a lot of work on that. I mentioned we set up the Novel Activities Program. This is a program that's really designed to provide clarity so that banks can innovate with new technology without getting themselves into trouble. Again, if it works right, you don't read about it because the institutions say custody and crypto assets, do it in a way that's safe. So these are the kinds of things that I think that go on behind the scenes that I'm very proud as a team we were able to do. And then, lastly, I'd say, I've been at this for a very long time. This is, I guess, my 30th year working on financial regulation. And as I said in my remarks, there's always more work to do, but I feel like we moved the ball down the field on some key initiatives in capital and liquidity and long-term debt that I hope will set up for the next stage of progress whenever that happens.
Well, I've been, I guess, talking to regulators now for a good long time, and whether or not it's Democrat or Republican, the one thing that I always hear is no one sees when you do it right. It's usually when things go wrong that you tend to have questions about financial regulation. But getting to that last remark about all the progress made on the liquidity front, or I guess also that there are some to-dos, I guess, with liquidity, and to-dos, it sounds like, with climate. There are questions that you raise about private credit and insurance. So, I'm sure there are folks who are watching who are asking, net it out, how safe is the financial system today? And how safe is it tomorrow?
Right. Chris, is a great question. First of all, I'd say that we have a sound and resilient financial system. It is serving a vibrant, successful, creative American economy. But I'm not somebody who is complacent about the risks in the system. There can always be shocks to the system. You want to create a system that is resilient to those shocks. And as I said in my speech, there's a lot of work to do to make sure the system is resilient enough to the kinds of shocks that we might experience. There's more work to do. I think we need to keep at the job of financial.
One of the questions that I asked about maybe a year and a half ago had to do with your role in regulation, but also financial regulation at the Fed. Because when most people think about the Fed, they think about monetary policy, which I sort of had alluded to. And many of the comments that you made had to deal with obviously preventing a replay of 2008 or some kind of depression sparked by the collapse of a major bank or other financial institution. But regulation can also have, and we've talked about this before, an impact or relationship with the economy writ large. In your view, what, with a little bit more precision, like, what do you think about that relationship between tweaking or loosening rules or making rules more stringent and the larger monetary goals like inflation?
So, let me take a step back. When the banking system is doing its job and performing the role that it does in the economy, it helps households to borrow, to buy a house, or if you're a student, to get access to loans you need for education, or if you're a business, to get access to the funds you need to start a business or to grow. And so when it's working properly, it does all those kinds of things. And what we try to do with supervision and regulation is make sure that the banks can continue to do that, even when there are shocks to the financial system, so that households and businesses don't suffer the consequences if things go wrong. One of the devastating things in the global financial crisis, many, but not all of your students were probably very young then, but you know what it meant for your parents. And, there were moms and dads who were the parents of kids on our soccer team who lost their jobs. There were families in our neighborhood, in our community, who might have lost their home to foreclosure. There are businesses that shut down because they didn't have access to the capital they need. The global financial crisis was devastating to the US economy, and it took more than a decade for the US economy to recover from that. So if you get that balance wrong and you don't have a resilient banking system in times of stress, the costs of that far outweigh the costs of compliance with a regulation.
Compliance is obviously a big question, particularly when it comes to issues like emerging technologies. And I saw and heard obviously about your observations relating to blockchain-based technologies, crypto, and the banking system. Obviously, there's a lot of energy and interest in crypto in Washington, D.C. right now. And one of the really big topics, both on the Hill and otherwise, is the topic of debanking. And the Fed has certainly had at least been sued over it, but some pretty high-profile people leading the charge. If Caitlin Long is watching, I'm sure she's like, yes, that would be me. That'd be me. What is your sense as to the debanking conversation, and how? Well, I'll start there and then move into the question about the nature of the conversation itself. Like, are the terms of the debate sort of clear from your standpoint? Are there areas in which the conversation could be made more effective? But again, just starting first with this debanking question, what is your response to it, and how have you been navigating the queries that you've been receiving?
Yeah, so, I would say we tried to take the position and have taken the position over all the time that I've been at the Fed. We don't tell a bank to do business with particular clients, and we don't tell a bank not to do business with a particular client. We don't encourage or discourage that kind of activity. That's for the private sector to decide. What we try and do is provide clear guardrails, rules of the road, so that when banks are providing services, they do that in a way that's in compliance with consumer protection. They do it in a way that's in compliance with safety and soundness. and they do it in a way that doesn't violate our rules against facilitating terrorist financing and money laundering. Those are the three big categories of things we kind of worry about. And we have lots of banks that are engaged in crypto asset related activities. You don't hear about them because they're doing them in compliance with the law and in a safe and sound way, and they're not facilitating bad actors. What you hear about when you hear about these things generally is something has gone wrong, and the institution or institutions in question have not protected consumers, or they've exposed the system to the risk of terrorist financing or money laundering, or they're not able to conduct the activity in a safe and sound manner. So what we have said consistently is we're trying to be straight up the middle, provide clear guidance and clear guardrails so that banks that want to engage in this activity can do that in a way that's appropriate. And we don't tell them they have to do it. We don't tell them they shouldn't do it.
Yeah. I've spent more time, I guess, thinking about. I teach securities law, as you know.
Among many topics.
I'm a man of many topics. But I've done enough banking, I guess, to dabble in it from time to time. And on the issue of clarity, just to kind of take that then full stop. Right now, I think all the different financial regulators are grappling with what will be an enormous amount of attention put on crypto. Obviously, it's becoming more visible from a political standpoint, but also from a policy making standpoint. And the question of regulatory clarity, the stuff I've been thinking about, again, a little bit more on the capital markets space, but even in the banking arena, there's the question of how regulatory clarity can be operationalized. Yeah. Whether or not it's the Fed that provides the guidance, or the OCC, or any other banking regulator, or the SEC. And, I couldn't help but hear, these questions about, effectively calling on all parties to make sure that notice and comment and rulemaking is fair. And I feel like, okay, there's something going on here in terms of how is it that rules effectively go to market in the government? Is the process by which the rules go to market somehow ending up in outcomes that are frankly leaving everyone a little frustrated, whether or not be on the regulatory end or whether or not it's on the industry side. I hear from folks who have some really brilliant ideas in the crypto space, and I hear from regulators who have some pretty good questions for folks in the crypto space. Like, do you have any sense as to what that go-to-market should look like? Are there any improvements? I mean, I'm not going to ask you to be the admin lawyer right now, but certainly even, if we want to go all into admin law, I mean, certainly there are some constitutional questions that will likely be sort of hashed out in the new EO order, but just in terms of how rules go to market and regulatory clarity in something like crypto, an emerging technology where there are still outstanding questions, but lots of interest. Do you have any thoughts about how that should be delivered?
Yeah, so let me distinguish two kinds of cases. One is where there's an existing regulatory framework that can and does apply, and the other where there's maybe need for further statutory clarity. So in the first case, we have a very well-established process at the Federal Reserve for notice and comment rulemaking under the Administrative Procedure Act. We follow it whenever we do a rule. We followed it since there was an Administrative Procedure Act. And it gives lots of opportunity for the public to provide input, public affected financial institutions, nonprofit groups, academics, whoever wants to. And, I would say I've been on the inside reviewing those comments, and we get really good, serious input from the public that we take seriously in trying to make our rules work as best they can. So that, I think, overall framework is really, sound and solid and can produce very good outcomes that balance the various perspectives brought to bear, within the statutory framework. The thing that is often difficult for the notice and comment rulemaking process with respect to new technology is new technology changes very fast, and the notice and comment rulemaking process moves very, very slowly. There's a second kind of area where there's really not clarity about what Congress wants, what the framework is that we should apply. So I think an important case there is for crypto-based stablecoins, which is an innovation that is being used in the crypto market primarily to trade from one currency to another currency and then to hold value in between when you're in between those trades. It might have broader application in other contexts over time, but that's where it's used right now. And at least in the United States, we do not have a clear stablecoin framework. And other jurisdictions do. The Europeans, for example, have a now well-developed stablecoin framework. It would be better for consumers, investors, crypto asset innovators, and the market if we had a framework in the United States that clearly laid out the rules for stablecoins. At the Fed, we've been asked to participate for many years now in bipartisan work that's going on to try and establish a stablecoin framework. There's been a lot of progress made over time. I don't know whether that will continue going forward, but a lot of progress trying to bridge the gap between the two parties over how to regulate stablecoins. And we've tried to provide our expert advice in that process. It's important to us at the Fed because if you think about it, a dollar-based stablecoin is a kind of private money that borrows from the trust of the Federal Reserve, of the central bank. So we want to be sure that if somebody is making that kind of promise and borrowing our trust, that the trust is well-founded.
So I'm going to let everyone, or if there are questions, because I have many. I mean, that was a very substantive talk that you gave.
Yes, it was
long.
It
was also substantive. I mean, there was a lot in that speech. That was highly interesting. But obviously, since you're mentioning your term as the vice chair for supervision ending soon, maybe you can tell us a little bit about your role in supervision and regulation, sort of moving forward as at, I guess, March 1st or at the end of the month.
February 28th. I'm going to step down unless we add an extra day. March 1st, I'll be serving as a governor, but not vice chair.
Well, how do you envision your role or in the questions of regulation and supervision after that transition?
Right. So under the Dodd-Frank Act, under the statute that is now governing the Federal Reserve, the vice chair for supervision is in charge of overseeing supervision and making policy recommendations to the board for regulation. I will not be doing that anymore. I'm stepping down from that role. I will not be serving on there's a committee on supervision and regulation. I currently chair it. I won't be chairing it. I won't be serving on it. I'll be serving as a board member. So like other board members, I'll participate in the debate about monetary policy and the other issues that come to the board. One set of those issues is supervision and regulation issues. I'll provide my expertise and my experience in my discussions with my colleagues about those issues, but I'm not going to be in charge of any of that stuff starting at the end of the month. That'll be up to the chair of the Fed to take forward.
Great. Any questions from the crowd? Yes.
Thank you. You mentioned in your 7th point that the Fed's role with respect to climate is limited to its impact on the financial stability. Kind of bridging that back into your 2nd point about stress testing, I was curious about how you envision climate as something that we will assumedly integrate into stress testing frameworks going forward. Will it be kind of centered to how we think about stress testing and how risks are evaluated, or will it kind of be exploratory kind of fringe risks that we consider?
The stress tests as currently constituted that focus on bank capital requirements, I don't think climate risk will be part of that. I think it's quite early for us to have an assessment of what the potential effects of climate change will be on, say, capital. But one of the things we did over the last couple of years is we did a exploratory pilot climate scenario exercise with the banks. And what we did in that is try to say to them, if X, Y, or Z path happens, transition path happens, if this sort of path happens with physical risks, how would you go about measuring the risk to your own balance sheet? And really that's designed to help them begin to think about good risk management practices, good risk measurement practices. And so, for example, one of the things that we learned, that the banks learned and that we learned from that process is they didn't feel they had sufficient information about insurance coverage of all the properties that might be affected by, say, the path of a hurricane. So that's an area that in the future, I would imagine supervisors and banks will want to help get banks to a better position to manage. So we're, I would say, at the very early stages of ourselves as regulators and banks being able to appropriately measure and manage those risks.
I do want to make sure that you got
The
microphone, so for people in TV land to.
Yeah, sorry, I'll repeat the question next time too.
Yeah, thanks. Nick Timmeros of the Wall Street Journal. Mr. Barr, the president issued an executive order on Tuesday night asserting greater control over budgets and activities of the independent agencies, so it expressly sets aside the Fed's role on monetary policy. You've been on both sides of this, first at Treasury and now at the Fed. So my question is, should political appointees at those agencies, people in your current position, be afforded the opportunity to exercise judgment about technically complex issues that might differ from the position of other executive branch agency heads, the OMB director, the NEC director, the attorney general, or the president?
Yeah, thanks for the question. First of all, let me just say on the executive order particulars, a lot of them have been issued. We're in the middle of analyzing them. I don't have anything on the particulars of the EO, but on your broader question, you know, as I said in my remarks, I think the independence of the Federal Reserve is absolutely critical, and it's critical in monetary policy, but it's also critical in our understanding of the law and how to apply the law to the banking sector. We've, you know, been a bank regulator for 110 years. And in that time, the Federal Reserve has exercised its independent judgment about bank regulation, about bank supervision, about bank enforcement. I think that has served the country well. I don't think we want other entities trying to influence, for example, whether a bank should be rated, you know, a 3 or 4 or a 5. I don't think we want other entities saying that we should or shouldn't issue an enforcement action on a bank for a violation of the law. So I think that independence has been an absolutely critical principle, in my judgment, that one that ought to be respected.
Yes, Juan Carlos.
Hi, I'm Juan Carlos. I'm a former student of Professor Brummer. I think it's fascinating to hear you talk about emerging technologies and kind of the how this is developing the financial system. I think for all the talk about the new efficiencies gained versus traditional finance, lower costs, ease of transaction settlements, not a lot is spoken about how regulators might benefit from kind of blockchain-based technologies. You know, is there some talk? Is the on-chain regulator coming soon? Is this something like exploring these efficiencies from the regulatory side, something that is being discussed?
I think that regulators can benefit from technology of all types, and it's important for us to stay current with those technologies. We do internal kinds of research to stay current on technology within the Fed. It's an important part of us staying on the front line of what's happening in the private sector, and also in thinking about how we might use it internally. I gave a speech earlier this week on artificial intelligence. Artificial intelligence is a really important tool that may transform our society in profound ways. it's incumbent on us to invest in that understanding of how artificial intelligence works, and also to think about in a very careful and controlled and methodical way how it might help us internally at the Fed. And I'll just give one example. Generative AI can help with coding. We have lots of coders at the Fed. You don't think of the Fed as a coding agency, but we have thousands of people at the Fed who are engineers because we help run the payment system. And it's important for us to do that efficiently and effectively. So one thing that generative AI, it turns out, is good at is reducing the amount of time that coders need to spend testing code, doing unit testing of code. And so we've been experimenting in a very controlled, very separate sandbox sort of way with, could we get coding efficiency by using generative AI? And it turns out, yes, we can reduce the amount of time we need to spend on unit testing, and therefore increase the amount of time, hypothetically, in the future that coders have to do more creative things that are higher value inputs into making sure our system is safe and sound.
Oh, let's give you 2 seconds for the microphone.
Chuck Torres from Bloomberg. Vice Chair, I remember when we had a Republican head of the FDIC, a Democrat as head of the Treasury, a Republican as head of the Fed, and they all had slightly different views of their agency mission. And I'm wondering if the sort of general lean now by regulators, take Travis Hill's 15-point manifesto at the FDIC, if this lack of diversity of views could create financial stability risks.
Greg, I think it's a great question. I do think that we benefit from having different perspectives among the regulators and at the Treasury Department. I've served in government 3 different times over the last 30 years, and in many of those circumstances have worked very closely with Republicans, either in positions within the government or in the executive branch or in the legislative branch, and vice versa. A lot of Republicans have worked with me when I've been in the government. And my sense is that different kinds of ways of thinking about problems, that diversity of thought, is really important in not creating blind spots in the system. And there are lots of different ways to achieve those set of different perspectives. At the board, we have 7 members of the board who engage in discussions about regulation and supervision, in addition to our discussions as participants in the FOMC process on monetary policy. And I know I personally benefit from having lots of different perspectives on the board. The necessity of having to talk through problems and explain them, and to take views that are different from your own. I think that's really, really important. And I've learned a lot over my career from people who think differently from me.
So I will ask one other question, and you can tell me if there's too much. Well, one part I think you will probably laugh or smile about, but it's going back to your stress testing question. And you can remember from your days as a professor, you sort of ask yourself, well, if I have too many years of my exam lying around, is it exactly? And you're like, well, why give you the test at all? I mean, I can't come up with anything
new under the sun,
basically, right? And so I think that's what you're kind of getting at a little bit with your stress testing questions for the banks. It's but I guess at the same time, I'm trying to draw like certain kinds of analogies, listening to Juan Carlos's question and others. When you hear about things like custodying of crypto assets, and the back and forth as to whether or not when applying for or the process of being required to custody a crypto asset, how transparent that process should be, seems to be a sort of a variation of a theme that we're kind of hearing, which is, on the one hand, we want to be able to provide clear rules for entrepreneurs to be able to go to market, but at the same time, you have to be able to control the risks to make sure that whatever risks are presented by those activities don't end up undermining the overall economy. The clearly at this point in time, the pressure is being, or the tension or the friction is being generated as to how much clarity can we get sort of ex ante in terms of what's needed to bring the product to market.
Yeah.
And then how much clarity can be given by the regulator, you know, ex ante, because, you know, there are real businesses out there and people are saying, well, if I don't have it, then I can't do my business. Or if other people don't know what the rules are, then they may not enable me to use their services, and that could run my business into the ground. And then at the same time, if something bad happens, then you get lots of phone calls, not just from the people in this room, but from the folks down the street who want to ask where you were. When it comes to sort of delivering and making just the balance, I'll just ask maybe from that perspective. Any rules of thumb? Because I don't entirely have a sense that it's resolved. It will be resolved one way or another, I suppose, in the next 6 months to a year in terms of just the regulatory and political battles, not just between the executive and Congress, but even between the regulatory agencies themselves. How do you approach that? And almost one of the very first sentences that you mentioned in your speech was this question of evolving risks. And even amongst different regulators, you know, if you're going to the SEC, you have to have risk. I mean, that's why people trade. I mean, without risk, you don't have the market anymore. On the other hand, when you move that, you know, to that question of what is a risk in the banking sector, well, you know, some kind of risk can kind of, you know, take out the dinosaurs in the economy, you know. So how do you get your arms around just the question of understanding that not only are risks different, but what risk means for different regulators is very different, right? And then again, to come up with a way to accelerate the sort of the go-to-market for the rules. Somewhere in there is a question, but you're smarter than I am, so I'm sure you can figure it out. Like how do you do that? Because it seems to me that the system is falling short. You have the entrepreneurs who are mad because they can't build their businesses. You have the regulators who feel like maybe the Administrative Procedure Act is being weaponized. You do have other stakeholders who feel like they want to have more input into the process, and everybody is just
Unhappy.
they're just kind of unhappy. So I mean, you know, when you look at that, if there are any, again, just general ideas or what you may expect, I'd be curious.
Look, let me say, Chris, the issues you raise are incredibly difficult ones to get the balance right on. So, you know, part of the reason everybody's unhappy is that it's not an easy thing to get right, whatever side of that debate that you're on. You know, even let's pick something like terrorist financing rules. Hey, we have strict rules on anti-terrorist financing. Our expectation is that banks follow those rules. If they can't follow the rule, they can't offer the product. Now, maybe we should have different rules, and you can debate whether the rules should be different. And then if we come up with different rules, we'll enforce them according to whatever that is. Congress can let us know that we should have a different balance. We should have less strict standards for terrorist financing. Then we can apply those. But given the rules that we have, our expectations are that banks will follow those rules. You know, if you are offering a product that is purporting to be a federally insured deposit product, well, you better do what it takes to make sure that you're following the rules so that it is federally insured. If you're a bank and you're engaged in an activity, your risk management practices should be commensurate with the activity. They're not, I don't think they're that complicated in that sense. We could decide to have a different balance of things, but if you want to be in the regulated sector, then you got to follow those rules. If you don't want to offer an insured product, then you still have to follow anti-money laundering rules, but you're not in the safety and soundness space. And same, you know, on consumer protection, you shouldn't offer a product that's fraudulent. You
Probably not a
shouldn't,
good idea.
not a good idea. You're going to go to jail. So there are some clear guardrails, and, people might say there's not a lot of clarity, but usually what they mean is there's clarity they don't like.
Well, with that happy future. Oh, was there one last question? Sorry, I apologize, didn't see. And then we will wrap it up.
We have Andrew Ackerman on Zoom from the Washington Post.
No.
He's asking, are you committed to remaining at the Fed throughout the balance of your board term?
So I have a term as a board member on the Federal Reserve that's separate from my vice chair term. My board member term goes to 2032. And I guess what I would say is I don't have any plans to step down. 2023 is a long time from now. So I haven't made any decision about that, but I don't have any plans to step down.
Yes, I'm
Hey, Governor
totally.
Rob Schmidt at
Good to see
Capital
you.
One. I'm curious that Chair Powell recently told, I think it was the Financial Services Committee, that the vice chair position had created some volatility at the board. And I think he seemed to say for regulated entities, and he seemed to say, hey, we did it ourselves as a board for a long time. I was wondering what you thought of that. And does that indicate that maybe he doesn't think this position is necessary and he may not want it filled?
So Rob, I'll say often what Chair Powell also says, which is I'm not going to comment on what another board member, certainly not the chair, says. I'll just tell you what my own perspective on the vice chair position. The Dodd-Frank Act created in the vice chair position in the wake of the global financial crisis because Congress thought that there was insufficient responsibility and accountability for supervision and regulation at the board. And there had been a long period of time in which supervision and regulation was not front and center for the Federal Reserve Board. And many people thought that that was a problem that contributed to the global financial crisis. So Congress stepped in and created this position so that there is that accountability and responsibility. And I think that's an important value for the system to have.
Okay. And do you have, okay, yes,
I'm
please.
fine.
Okay, good.
But just you have this captive audience of students who.
I know.
Yeah.
There's this that where if I come and like my car is keyed or something. So very last, very brief.
Thank you. Thank you for being here, Vice Chair Barr. I had a question about your reference to private equity getting involved in life insurance. Over the past few years, we see them getting involved in housing, healthcare practices, car washes, whatever it may be, sectors that target everyday Americans. Curious if the Fed has taken note of that, and do you think there should be any regulations to manage these investments to make sure they don't serve at everyday people's detriment?
So, we have a narrow focus within that. So I'm looking not at the full set of issues you might raise, but really at what are the financial stability implications of different structures. And so the thing I was highlighting, for example, in insurance is that the particular structure that private equity firms have taken with respect to life insurance has also moved that sector more towards investment in private equity products and also the use of short-term liabilities. And that combination can create some instability risk where in a traditional life insurance context, you might not have seen that kind of instability. So it creates, instability is too strong, vulnerability to a potential shock. And so we have to pay attention to those vulnerabilities because they can have spillovers in the financial system.
Well, with that, we are going to end this wonderful tour de force and substantive conversation. Let's all thank the vice chair for his time. And we have no more microphones and cookies. Okay.